Hello, welcome to the Treasury One weekly technical analysis video by Sven Henrik from Northman Trader. It's March 29th. It's been a week of major technical pivots across the globe, currencies and markets. Last week we discussed the potential for a month-end rally from key support levels. We had this chart in the S&P 500. This was a key support zone here, which goes all the way back to the 2016 highs. It hit it perfectly, and we had obviously a massive rally following this unprecedented crash since basically 1929, and followed by the largest rally since 1933. So volatility remains extremely high. We had obviously more interventions from the Federal Reserve, but we also reached historic oversold levels. So the rally made sense. It also made sense where it initially stopped, and this is also very key to watch here going forward. There is no clarity in terms of whether this is simply a bear market rally, which will peter out at some point anywhere here or there and make new lows, or whether we're going to see a sustained recovery. Given the incredible backdrop of the continued deterioration in economics, it's hard to see a sustained rally, but at the same time, we also have unprecedented central bank intervention that make 2008, 2009 look like child's play. So when we look at the S&P, where did the rally stop? It stopped at a key trend line that was previously broken. It also stopped at the weekly 200 MA. So all that's taking place in markets makes perfect sense in regards to technicals. And so now what markets have to prove is they can either get back above this trend line and approach the next level of resistance, or failing to do so invites a retest of the lows or even new lows here into key pivot support that is offered here in this area, 2000 to 2100. So next week, obviously, we're going to have still month end. We're also going to have a number of economic data that is probably going to be very much bad in terms of the shutdowns that are taking place in the United States, obviously now, in addition to what's happening in Europe as well. So price will have to negotiate, and central banks offering record liquidity will have to negotiate this out. But clearly we are now within a larger price zone. This rally here has brought short-term oversold readings, but the long-term oversold readings are still very much active. So it is what was a conviction buy is now a more tactical orientation here, and price has to prove itself out whether it can recover here or not, or indeed will make new lows or retest the previous lows. So no clarity on this, and we are at this point more tactical, with still a long position here, but also a tactical short here. And so we are navigating this at this point from our perspective, unclear. And I think next week will be very critical, not only on the virus front, but obviously on how markets negotiating the ever deteriorating economic data that is coming in. On the currency front, as I mentioned at the outset, key pivot week, we saw that across currencies all over the place. The pound hit back its all-time lows here in 2016, and it was a violent reaction. We see these reactions everywhere. What's interesting here is that the bounce was so significant and it recaptured this previous support line. And so now we're finding ourselves back in this range. As long as this support line here can hold around 11987, then we again remain in this structure here, this descending structure that we ultimately see as bullish once it is able to confirm the breakout. But that hasn't happened yet either. But we can see, obviously, these pivots are critical with all of these currencies, right? This previous high here was rejected back at the lows here in 2008. So currencies have memories, very clear memories, and we see that here as well on the euro. The euro chart, frankly, is messy. We have a clear double bottom here, very clean in this previous support zone here. Made sense to bounce. This channel here is now a mess from my perspective. I like to see clean channels. This is now not clean, and obviously with the shock events that we just had in recent weeks, that is also not a surprise. But what is notable here is that this breakdown here has now proved itself to be a fake out. So we're back above this trend line that was resistance before. It has now to prove itself that it can stay above. If it can, then our continued more bullish outlook on the euro will can take hold to tackle this trend line here ultimately. But remains to be seen in this in this environment of high uncertainty. The dollar. Speaking of pivots, where did it stop? It stopped right here in the 2017 highs. Very clean as well. Just what we saw with the pound and what we saw with the euro. This now doesn't tell me anything, to be perfectly honest. We're right back in this range that we were before. We had this shock out to the lows. We had this breakout that was also proved out fake, and we're right back in here. This has to negotiate itself, and we're now again back where we were before. So there's absolutely no clarity on this whatsoever, but clearly we have a proven point of resistance. For the dollar to be really successful here, it needs to break out and stay above this trend line. So far it has failed to do so. On the ZAR, well, obviously the big news is the downgrade by Moody's. The chart has continued to prove obviously bullish from a technical perspective, obviously negative for the ZAR. This inverse continues to hold very cleanly. Price hit the previous highs here. We're vastly overbought, obviously, on the RSI. Now we have a downgrade, and obviously that would suggest further weakness to come. And as it's a key significant economic event, we have to look at the possible pivots that we can see. In shock events, obviously, you can see extremes happen extremely fast. We had this inverse pegged with an ultimate target of 19.9. That inverse remains technically active. I would expect, if we move higher here in this direction, to see initial resistance here at this trend line. This goes back all the way back to 2001 time frame. The issue obviously you have is that the RSI is so extremely overbought, which can lead to rejections, but it has room. I mean, we've seen this here before. It gets even more extreme. The question then is how high can it get? The obvious point here, if we see a massive reaction and break above this trend line, would be our inverse target. That would be a clean technical pivot point, 19.9, where this can then revert itself. Technically, just long-term speaking here, there's also, in case you get a real shock event, there is a pivot zone up here. This is the 1.618 FIP at 2174, and then of course you have a trend line here. So that could be an interesting point of confluence. I would not expect that to happen immediately at all. I think there's too much resistance here in this area to at least expect a major reversion point at this stage, especially if you then assume that if something in this range happens, the RSI gets into a major overbought point as well. So that I think is key to watch here, this particular zone. If we get to 19.9, this technical pattern would be satisfied from my perspective, and therefore that move would be concluded and this pattern be satisfied altogether. So it'd be interesting to see how this plays out here into next week. I think there's a lot of thinking here that this trend line is maybe the end of this move. It may well be. I'm just pointing out that this pattern here has a technical move to 19.9. Hope this was all helpful, and good luck this coming week. It looks to continue to be a very volatile market environment. Thank you.